Some of the key implications for regulators or investors are not to put yourself in a position where you're a demander of liquidity, if possible, as an investor. Try to organise yourself and your investment arrangements so that you don't need liquidity, because we know it's been choppy and we know that the market structure's changed.
One of the difficulties with liquidity or liquidity risk is that, like a number of risks, for example, credit risk, it's highly episodic. So a lot of the time, liquidity in a given market, for example, corporate bond markets or swap markets, for example, may be entirely adequate, but then periodically it can disappear with serious consequences. And the danger, I think, is that because it's there most of the time, people can make their plans on the assumption that it's always there.
It's particularly important recently to focus on the amount of liquidity supplied by dealers, because dealers have been reducing the degree to which they make markets. So if a large investor calls a dealer to lay off a big block trade of, let's say, bonds, the dealer is less likely to want to hold that position on its own balance sheet and will delay the investor's trade, or will give it a worse price.
Investors, they both consume liquidity in the sense of being able to trade when they need to, but they may also actually provide liquidity. And so especially long-term investors investing with sophisticated asset managers can really benefit from providing liquidity, whether it be from providing liquidity through buying illiquid securities or by buying stocks that are being sold heavily by others.
And if you're a liquidity provider, which may be an attractive thing, keep in mind the risks. Scrutinise strategies to think how much they depend on the existence of liquidity to perform well, and be mindful of the effect on your portfolio of swift changes in liquidity.
So there's a liquidity premium for providing liquidity, which means that you can earn an excess return. And this is a part of what I call the market is efficiently inefficient. That there's a lot of market efficiency, but there's also a compensation for liquidity risk, which you could think of as market being not completely efficient, but it is a pricing of that liquidity risk. Long-term investors who have that ability to provide liquidity and want to profit from that, that could be through event-driven investing like merger arbitrage.
Well, I think structural issues are very important. So if we're thinking about the asset management industry, pooled vehicles, mutual funds are a very important way of delivering our product to clients. But it's important to get the structure right so that when clients go in or out of those vehicles, it doesn't harm the interests of continuing investors.
When there is a merger, the target company, the company that's being acquired, it typically faces a lot of selling pressure from investors who are afraid that the merger might not go through. And so as a result, there's a price pressure down on the stock, and other investors who have the sophistication and the long-term perspective can actually buy the stock, provide liquidity, and earn the liquidity premium, in fact, earn an excess return over this event period.